It's got a market cap of $547 billion. It's a consumer technology stock, a price to earnings of just 10, earnings per share annual growth over 5 years of 32%, and a debt to equity of just 0.5. CAGR for EPS is growing strong. You're seeing strong appreciation. 2011, it was trading at $12.5 per share. This is up to $27 per share at some point. So we've seen some appreciation over a 5-year period. Let's look at the advanced metrics, see if they are just as strong as this first impression. And what you're seeing here is a gross margin of 40%. It has an operating margin of 30%, a net profit margin of 23%, return on equity of 42%, revenue growth annually over the past 5 years of 28%, net profit growth on an annual basis of 29%, shareholder equity at 21%, and free cash flow CAGR of 29%. The debt to free cash flow is less than 1. So just first right off the bat, we're going to look at the financial reports still, but these are all the signs that you want to see in the business. When you can find businesses with these attractive fundamentals, double digit and into the 20% growth range, as well as this high of return on equity and healthy margins, like it doesn't get better than that. The last part of it is the valuation. And in this case, we're only seeing a PE of about 10.5. So all things considered, like it looks really attractive right off the bat. So looking at the statement of operations here, we're seeing that net sales in 2015 grew to $234 billion. This is up from $171 billion just 2 years ago. So decent growth from revenue standpoint. Operating income's up from $71 billion versus $50 billion essentially in 2013 there. And lastly, looking at net income, we're seeing $53 billion of profit versus $37 billion of profit there. All good signs. So they have about $21 billion of cash plus marketable securities, puts them at over $40 billion essentially sitting ready to deploy. And this is up substantially from the previous year where this is at about $25 billion. So we like that. Another positive sign. Looking at debt, they are operating with about $53 billion of debt. But again, based on what we're seeing from a profitability standpoint, that certainly seems manageable. And in relation to their shareholder equity here, it is a healthy relationship, definitely less than 1-to-1. And we're seeing about $119 billion of shareholder equity as of the most recent year. Now, lastly, we're going to look at their statement of cash flows. We're seeing $81 billion of operating cash produced in that time. Really strong. And you're seeing that this is consistently growing from 2013, where it was just at $54 billion. But these are all positive, growing. This is a massive business. Again, plus $500 billion market cap. So really high already. And all the advanced metrics showed really positive signs. But let's just see a couple years ago where they were at. So in 2011, they were at $44 billion in revenue. So definitely some substantial growth in that time. They were still profitable at the time with a net profit of $26 billion there. So good signs there. We can look at least where their shareholder equity was. And it was at $124 billion as of 2013. And this has changed from a period of $118 billion the year before. So again, steady growth. Their debt doesn't look overwhelming. They actually started taking on debt in 2013, but before that they had zero long-term debt. So what this kind of shows is now that they've reached a point of proven sustainability is that some businesses then start to take on debt where it's manageable. It's definitely below a debt to free cash flow of 1. So they are more than capable of taking on this debt. And it's just one of those things that when you understand your business and you know that you're in a strong position, now you can start to take on a bit more risk, but not at an excessive rate, to help further accelerate your growth, increase your product or service exposure to new customers, and continue to grow the business at a healthy rate overall. Looking lastly at the statement of cash flows here, in 2013, they had $54 billion of operating cash. This is up from $38 billion in 2011. So all positive signs, all things are trending in the right direction. We can now make a decision whether to invest, short, or pass. But based on what I'm thinking this is probably an investment. And just a quick summary, once again, we're seeing a $547 billion market cap. This is a consumer technology stock, a PE of 10.5, healthy debt to equity ratio, and strong growth across the board with a healthy return on equity and healthy margins. I like what I'm seeing. This is a business that, as of 2016, it's definitely appreciated in price, but I have suspicions that this company is going to continue to appreciate further. So I'm willing to take a bit more of a sizable bet on this position. Right now, looking at our total portfolio size, it's at about $21,000. So $5,000 is about 25% of the portfolio. But based on everything I'm seeing, also in line with that relatively attractive PE ratio, I think it's worth making a bigger bet, and let's see how we do. Boom! We just made $50,000. $50,000 on this stock. If you see those favorable trends, you are seeing those attractive growth metrics all around, fundamentals are really sound, and you can make an investment with high conviction where the price looks cheap. You are making decisions like that. We're seeing 953% growth in that time, CAGR of 27%. And look, we literally tripled our portfolio size just with one investment. And interesting enough, this is when Berkshire Hathaway disclosed a roughly $1 billion Apple stake. So this is preaching the goat's words right there. You're seeing exactly what Warren Buffett was doing when he invested in Apple. And now this guy's making a $1 billion investment. Think of the return he has made in that time, and you've seen it. Their stake in Apple grew to, I think, upwards of $150 billion at one point. It may have been even higher. So insane growth. When you have strong conviction and you find good businesses, these are the types of investments you want to make. You want to seize these opportunities, and in this case, it paid off. And we only invested 25% of our portfolio. So that's still a pretty sizable position, but now we've put ourselves in a great spot, and now we're up to $71,000 in the stake. We've now hit the global rank position of number 1. So let me know what you think, and also make sure to like and subscribe, and tell me what you want to see. Do you think I made the right investment or not?